Welcome to the Deep Dive. Today we're looking at Tronox holding PLC's Q2 2025 earnings call from July 31st.
And right off the bat, this wasn't your standard quarterly update.
No, definitely not. The market reaction alone told you this was, well, a major corporate reset. A really severe guidance revision hit hard.
Exactly. It felt like a signal that any hopes for a quick cyclical recovery just evaporated. Management basically had to shift into full defensive mode.
So let's start with those headline numbers, because compared to what analysts expected, they were pretty devastating.
Yeah, devastating is a fair word. Let's just lay them out.
Okay. Adjusted EPS, a loss of $0.28 per share. The consensus was looking for a loss of only 4 cents.
That's a $1.24 miss, a huge gap. Tells you something went seriously wrong on the cost or revenue side compared to expectations.
And revenue didn't help. $731 million reported. Consensus was way up at $790 million.
So a $59 million miss there. Importantly, that's down 11% compared to last year. That top line weakness flowed straight through.
Straight through to the margins, which, I mean, that's where the pain looked really acute.
Oh, absolutely. Adjusted EBITDA came in at just $93 million.
$93 million. Wow.
Which gives you an adjusted EBITDA margin of only 12.7%. Now, compare that to the year before. It's a drop of 690 basis points, just brutal margin compression.
And the cash flow picture, because in this kind of business, cash is king, right?
It really is. And free cash flow was negative. A significant use of cash. They burned through $55 million in the quarter.
Burning cash like that in a capital-intensive cyclical industry.
Yeah.
That's a serious red flag.
Definitely a red flag. So, okay, the numbers are bad. We get it. Let's dig into why. What did management actually say caused this operational collapse? Was it pricing falling apart or just volumes disappearing?
They pointed squarely at demand.
Yeah, overwhelmingly volume. Management used phrases like weaker demand across most end markets. They specifically called out a softer than anticipated coatings season.
That summer boost just didn't happen.
Right. And they mentioned heightened competitive dynamics, which you can probably read as pressure, maybe from China, and just generally weak pull from construction and housing globally. High interest rates biting,
And the volume numbers back that up, don't they? Down 11% year over year.
And crucially, down 2% even from Q1. Sequentially down, when you'd normally expect a seasonal lift. That tells you the weakness is pretty profound.
So how did this play out in their main product lines? Let's start with TO, their biggest segment.
Okay, TO revenue was $587 million. Now, the interesting part here, maybe the small silver lining, is that pricing was flat. They held the line on price.
Left the volume.
The volume hit was the killer, down 11%, and that accounted for basically the entire revenue decline in that segment.
And then there's Zircon. That often leads the way down, doesn't it? The canary in the coal mine.
It absolutely took a double hit this time. Zircon revenue got hammered by a 10% drop in sales volumes and a 10% drop in average price or mix.
Ouch. Volume and price down double digits.
Yeah, when you see both deteriorating like that, it screams structural weakness. Likely tied, as you said, to that stalled recovery in China, especially ceramics and other industrial uses.
Okay, so demand cratered. But costs were also a factor in that shocking 42% year-over-year drop in adjusted EBITDA. What was happening on the operational cost side?
Two main things, really. First, something they knew was coming, high-cost inventory flow through. Remember, they had that expensive production run at the Botlek plant back in Q1?
Right before they decided to idle it.
Exactly. Well, that inventory hit the cost of goods sold line item in Q2. Painful, even if expected.
And the second factor was more of a surprise, wasn't it? Freight costs.
Yeah, freight was unfavorable. And management explained this was partly due to some strategic, proactive moves. They were shuffling inventory around the globe because of the Botlek closure.
Makes sense. Logistics get complicated.
But they also incurred costs shipping pig iron, which is a key co-product for them, from South Africa to the U.S.
Why do that now?
Seems like a hedge. Getting that supply secured ahead of potential tariff changes. Smart strategically, maybe, to de-risk the supply chain, but it definitely hit the Q2 profit and loss.
So the market's falling apart, costs are tricky, management basically had to pivot hard, which brings us to their strategic response.
Yeah.
Cut costs, save cash.
Pretty much. The big immediate move was idling that Botlek pigment plant in the Netherlands.
A tough decision, I imagine.
For sure, but probably necessary. Botlek was known to be a higher cost facility. Shutting it down, even temporarily, helps the overall cost structure immediately and takes capacity out of an oversupplied market. It's like, as you said, ripping off the Band-Aid.
And alongside that, they kicked off a much bigger cost-cutting program. a self-help initiative.
Right, an accelerated cost improvement program. They're targeting $125 million to $175 million in sustainable run rate savings by the end of 2026.
Okay, let's put that number in perspective. If their new full-year EBITDA guidance is, say, $410 to $460 million, finding up to $175 million in savings.
It's huge. It's potentially adding like a third or more to their underlying operating profit before any market recovery. That tells you either they found a lot of fat to trim or the situation is dire enough to force really deep cuts.
And they seem to be moving fast. Management said they're ahead of schedule. They expect to exit this year, 2025, with nearly double the cost savings they originally targeted for the year.
Which sounds great, but you have to ask, right? Is there a risk here? Are they cutting too deep, maybe sacrificing muscle along with the fat just to hit these numbers quickly?
That's always the balancing act in these situations.
Management claims they're focused on sustainable savings, and they are trying to protect the future somewhat through capital discipline. They slashed the CapEx budget again.
How much lower?
Down to less than $330 million for the year. That's another $65 million cut from their already reduced plan. They say they're only spending on essential maintenance and the most critical strategic projects.
Like that East OFS mining project in South Africa. Is that still going ahead? Because that's important for costs later.
Yes, that one's still on track. Commissioning expected in November. That's key because it should bring lower cost feedstock into their system, starting to impact COGS late this year or early next.
And for near-term cash worries.
They shored up liquidity a bit, secured a new short-term $50 million inventory financing facility in July. It's renewable, gives them a little extra cushion.
But the leverage picture is still concerning. Net leverage at 6.1 times trailing EBITDA. That's high.
It is undeniably high.
Yeah.
The saving grace, though, is the debt maturity profile. They don't have any major debt coming due until 2029.
So they have time. Runway.
They have runway to hopefully ride out this downturn, but the clear signal of just how cautious they're being was the dividend.
Ah, yes, the dividend reset.
A big one. The board cut the dividend by 60% down to just 0.05 cents per share quarterly.
You don't make a cut like that lightly.
Absolutely not. It screams that balance sheet preservation and debt reduction are the absolute top priorities right now, way ahead of shareholder payouts. Survival mode, essentially.
Okay, dividend cut, CapEx slashed, costs being attacked. What does this buy them looking forward? Because that brutal Q2 forced a complete reset of the full-year guidance.
Right. The new guidance for fiscal 25 basically assumes this weak market continues through the second half, but it does imply things get better than Q2.
What are the new numbers?
Revenue now guided to $3.3 to $3.1 billion. Adjusted EBITDA between $410 and $460 million. And that free cash flow burn we talked about, they now expect to use $100 to $170 million for the full year.
So still burning cash for the year, just maybe less intensely in the second half. Why is the second half guided higher, though, if the macro picture is still so weak? This seems like the pivot point in their story.
It is. Management is banking on what they called a step change in their cost profile, specifically hitting in Q4.
A step change.
Two key drivers they highlighted. First, those cost savings programs we discussed really start to bite and deliver results on the bottom line. Second, that lower cost feedstock from the new mining projects, especially East OFS once it's commissioned, starts flowing through into their cost of goods sold. That should provide margin relief late in Q4 and into next year.
Okay, cost structure improvement. Anything else driving that second half optimism?
Yes, they also mentioned expecting incremental earnings from strategic sales of other products, particularly in Q4.
Other products, not TO Euro or Zircon.
Seems like it's related to rare earths. These are co-products they get from their mining operations. Selling these can provide little high margin boosts, kind of a diversification play.
Interesting. And on the commercial side, are they pulling any levers?
They're definitely focused on trade dynamics. They mentioned seeing good initial sales momentum in India.
Why India specifically?
Anti-dumping duties against Chinese TO Euro imports went into effect there in May. Plus, Tronox can leverage the Australia-India Free Trade Agreement, giving them an edge.
Makes sense. What about Brazil? That was another potential anti-dumping case, wasn't it?
It is, but it's become more complicated. They're still waiting for the final duties, now expected maybe early Q4. Management sounded a bit frustrated, actually.
Why frustrated?
Because the provisional duties lapsed, and this delay in finalizing the permanent ones has apparently created a window for Chinese producers to flood the market, so it's causing temporary competitive pressure before the expected relief kicks in. So
banking on those Brazil duties actually landing is, well, It feels like a risk, given the delays.
It's definitely a risk, but it's also a potentially significant catalyst if and when it happens. And you have to see this in the context of the broader industry.
You mean capacity shutdowns?
Exactly. Globally, since 2023, something like 750,000 tons of TO capacity has been shut down or idled, and recent announcements added another 280,000 tons to that total. It's a lot of supply coming offline.
So management's view is that the industry structure is fundamentally tightening.
That's what they argued. They said the industry is edging towards the cycle going the other direction because of these closures, and it's a big means, but China's recovery, or lack thereof, is still the huge wild card for pricing power.
Which brings us back to the core dilemma for you, the listener, doesn't it?
Yeah.
You've got this potential inflection point, cost cuts hitting, trade actions may be helping, but it's layered on top of extreme financial leverage. How did that play out?
Precisely. And the market reaction shows the fear. The stock traded down near $3 intraday during the call, just getting crushed.
The market is clearly pricing in the worst. Terrible demand, high debt, continued pain.
Which leads us perfectly into our next segment. Now remember, this is not financial advice. We're just exploring ideas. But given the setup, there's potentially an outrageous but plausible trade here.
Okay, let's hear it. How do you play this kind of situation where the downside seems priced in, but the timing of any recovery is so uncertain?
You could look at leveraging the structural asymmetry. The high leverage cuts both ways. It amplifies pain on the way down, but it could seriously amplify gains on the way up if things turn.
So you're thinking options.
Specifically, long-dated, out-of-the-money calls, maybe expiring sometime in mid-2026.
Why long-dated in OTM?
Long-dated gives you time. You're buying runway for that Q4 inflection point, the cost savings, the potential Brazil duties, maybe even some market improvement to actually materialize. Out-of-the-money keeps the initial cost low, acknowledging this is a high-risk bet.
Okay, what's the core rationale? Why might this work?
It hinges on everything we've discussed. One, the company likely survives. No major debt due until 2029 gives them breathing room. Two, the current stock price, near those lows, already reflects the terrible news and the 6.1x leverage. The pessimism is arguably baked in.
So the downside from here might be limited, barring outright catastrophe.
Plausibly, yes. Now, the upside trigger is that Q4 synchronization we talked about. Imagine if, maybe early Q4, two things happen almost at once. Those Brazil anti-dumping duties are finalized and confirmed, and the company demonstrates that promised step change in costs and EBITDA, maybe beating the low expectations.
What happens then, theoretically?
That high leverage flips from being a burden to being a rocket booster. Even a modest beat on EBITDA could drastically improve the leverage metrics. If the market sees leverage falling rapidly and sees industry supply tightening from all those closures,
the narrative could shift very quickly from survival story to recovery play.
Exactly. Funds might rush back in, realizing the balance sheet crisis is averted. The stock could re-rate dramatically and disproportionately. Those cheap, long-dated calls could potentially see massive percentage gains. It's a pure bet on execution and timing, meeting a slightly improving backdrop. High risk, high potential reward.
Okay, let's recap the main takeaways here. You got this intense near-term pain-weak demand, pricing pressure, particularly in Zircon.
Countered by really aggressive internal actions, that big $125 to $175 million cost-cutting plan, the Botlek idling, the focus on cash.
And then these specific potential catalysts on the horizon. The India ramp-up, the hope for Brazil duties finally landing, and the cumulative effect of all that industry capacity coming offline.
They've sacrificed the dividend and cut CapEx to the bone to make it through this period, which leaves us with the big structural question for you to think about.
Which is?
With almost 1 million tons of global TO capacity taken out since 2023, what happens to pricing power when or if global construction and coatings demand finally starts to normalize, maybe next year or the year after?
How fast could things snap back? And what does that mean for a company like Tronox, which will hopefully emerge from this leaner and more cost discipline? That's the longer term picture.
Definitely something to ponder. Thanks for joining us for this deep dive.
And just a final reminder, everything discussed today is purely for informational purposes. It's not investment advice. Always do your own thorough research before making any decisions.